So Joe, can you talk about our outlook for bonds and stocks over the next decade, and how does that differ from other prevalent views in the industry?
Sure, Noni, and for frame of reference, for many investors, the past, again, if you look back 20, 30 years, the average return on a balanced portfolio, roughly 6% or so. Our outlook for some time has been more guarded than that. I'd say if you're bold enough, and where we center on is the next 10 years or so, roughly 3.5 to 4% is the central tendency. But that's over 10 years. I think also we have to be careful. Again, we don't provide short-term forecasts, I think purposefully because of the wide uncertainty. That said, part of the reason why longer term that 4% is a modest normalization in interest rates and modestly higher inflation, which right now only closely off the zero bound, say, in the United States for short-term rates. So I think there's a skew towards the shorter-term outlook for returns, regardless of what the equity market does, and that's given on the fixed income side. So I think even I would shade it a little bit lower than that. Again, relative to inflation, it's still positive real returns as the most likely outcome. But again, we've been very guarded. So would I say are we alarmists? No. Are we saying we're on bubble territory? No. But at the same time, the sort of corrections that we saw part of last year and that January of 2016 that we're witnessing now, I wouldn't say it's surprising either. So again, not necessarily forecasting it, but it's not a surprise. And so I think we're going to have to deal with this sort of volatility in a lower return environment. I mean, fair?
Yeah, absolutely. No, talking about the short-term volatility, these are the periods in which you are glad you have some allocation to bonds, right? I mean, clearly the stock market is digesting a lot of news on the global front, on the Fed, as we've been talking here. But what is important is that long-term perspective, right? Obviously, the market is going to try to basically discount this short-term news, but over the long term, is not necessarily a completely pessimistic view. Certainly, as Joe was pointing out, much more modest than the historical averages of the stock market, simply from where we're starting from in terms of valuations, right? But yeah, I mean, generally a modest, moderate, but still positive return outlook for both bond and stocks.
So the question I often hear from clients then is, how should I be thinking about my asset allocation given that outlook? What are your thoughts on that?
Well, I mean, clearly I think the probability of success, if that is evaluated in terms of meeting a spending goal, a sort of return target, by definition, our expected return frontier for various asset classes has just come down for no other reason the past 10 years because of the lower interest rate environment. And that's even without the valuations, which in the U.S., look a little bit higher relative to history. So I think, those probability success measures just we're going to come down. So there's two ways one can react to that. One can take on more risk, and there's no free lunch here, more equity-like risk to achieve, more aggressive sort of spending or savings targets, or just reduce one's, the sort of the spending or savings, or dedicate more to savings because what you clearly can control, and again, not gonna forgive my other comments, clearly minimizing costs. I mean, you should be doing that in any interest rate or market outlook environment. All the more reason, though, when it's low return, because those costs are going to take on even way more as a percentage of the total return of the portfolio. I mean, I think there's, it's just the market's gonna test investors' patience, I think, over the next 2 or 3 years, more so than even 3 or 4 years ago. And in some ways there was more grave concerns, just these scars of the financial crisis. I recall personally in 2009, 2010, really deep. I mean, the wound wasn't healed. And ironically, as time passes, the market performance has been really strong on the equity side. Fixed income has actually done very well too, because we haven't had the rise in rates, right? So I think now we're sit here and you're farther removed from the crisis, and yet our patience actually going to be more because return outlook lower. And so I think that's the mindset. But
yeah, and there is no easy way out. Unfortunately, that's not a great news. But the point is that it's a subdued return outlook both for stocks and bonds. Similarly, with the equity risk premium that we still believe that is going to be there, but at a lower level. So the temptation to reallocate or to overweight one asset versus the other, we don't think that there is much basis for that, other than considerations about targets and maybe taking on more risk with
Yeah.
with the eyes wide open in terms of and knowing what you're doing in terms of your portfolio.